In this next section, what we're going to move away from is the intraday trades and the intraday profile structures and how they can then generate certain types of movement. I'm going to go and look at a few trades which relate much more towards what happened on the previous day, so the structure of the previous day's profile and what this indicates. Now, we've already covered some of the more typical day types and what you can then expect the following day. Now what we're going to go and have a look at is the slightly more obscure anomaly type profiles and what you can expect there. We're also going to move this into looking at multiple profiles and the story that they tell you in terms of generating trades, in terms of giving you a trade on one day where you can say, right, because of the structure that we've just seen, there is actually now a scope for a certain type of movement. So we're going to start this off with what I call a Christmas tree profile. And again, this is a more proprietary trade and a trade developed by one of our senior traders as a way of sort of visualizing and understanding a certain type of movement. And this has elements of your kind of 45-degree fat bottom profile type scenario. And so it can be a trade where you take aspects of that, and this is where you get crossover of ideas. One person sees an entire day, another person sees a certain sort of short-term structure to give a similar type of movement. But when you have an entire day that sets up in this way, you've then got a certain expectation for the following day. So what we're looking for here then is a similar kind of fat bottom, fat top profile. The aim with, or what you're looking for, what makes this pattern sort of clear and obvious, is that you have direction, but it's not a full-on trend type move. So it's this anomaly trend move. It has aspects of trend about it without a full-on trend. And what you're then looking for is also a small tail at the bottom. And so when we talk about a Christmas tree, you're imagining that you've got half a Christmas tree. So if you imagine how you used to draw a butterfly when you were younger, you'd draw half a butterfly and fold the page over with paint and it would make a symmetrical butterfly. Imagine your profile is that half a Christmas tree type structure. You will often get a small tail on the bottom, which creates the kind of stalk of the Christmas tree as well. This is an indication that on a move down, sellers have tried to keep the move going and they've not been strong enough, and then they've essentially been held back at a slightly higher price. And this is what creates that kind of fat or high, wider base of a Christmas tree. So it doesn't have the full trend element that the direction can be maintained for the entirety of the move. Whereas if you're thinking of a trend type profile, the trend aspect of it is maintained for the entirety. And so you have this very sort of flat edge profile. With a Christmas tree, it grows in terms of width as the move goes down. So it's showing that yes, there's still willingness to go down, but this is constantly running into more and more difficulty as the move falls. So this is predominantly a next day trade that people who have generated the move down. The difference between this and a 45-degree line trade is that the Christmas tree has direction and is then reversed, whereas the 45-degree doesn't necessarily have to have too much direction, just the inability to keep going, which generates the direction. So in terms of you thinking about the sequencing and order of how these things develop, the 45-degree generates the reversal, whereas the Christmas tree directionally moves and then fails to continue it, which is what then creates the reversal. This again is a situation where, because you build this wide base, you need a lot of energy to continue the move. And you also need acceptance to continue the move. Otherwise, you just create a longer tail, a longer kind of stem on your Christmas tree, if you have this kind of snap through. What you got to be thinking about is not only is the symmetry to generate the pattern or the imaginary Christmas tree, but you've also got to think, if you have a profile that is essentially shaped like that, a sort of wide triangle, to balance the entire area, you need time spent down here. You don't need a rush through, you need time. So you need volume done down here below the base of the Christmas tree. And apologies for drawing it over there in a slightly messy way. When I show you the example, this will be a little bit clearer. So what you're looking for is, you're looking in general for a reversal back up the Christmas tree. As you find that there aren't any more sellers and the market will then drift back up. But what you're looking for is, this is a steady move. And the onus then is on finding an entry point, but then sitting the move out. It's a steady move where you're just waiting for it to tick, 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 nice and steady, drifting back up. That's the important bit that you're interested in. And so the onus is on getting yourself in and taking your risk early, because adding to a move like this is very difficult. With something like a trend move or a machine gun type move, you can play the break, and as soon as it provides you a little pocket of low volume, you can add and leverage your trade up. Whereas with a Christmas tree type move, you need to get yourself in early, because the grind back up naturally makes it very, very difficult to enter position after that, because you don't really get shown you're right, you just get shown that you're not wrong. And that makes it very difficult to add to a trade. So if you understand the nature of the reversal, it makes it much, much easier to justify and to rationalize your entry point and the way that you're going to execute that entry. The reason for the steady reversal as well is that sellers on a Christmas tree will have sold at multiple points on the way down. And so in doing that, they have got themselves various different stop out points. And this is why you don't get the rush up, you get this steady grind up, because people slowly and progressively exit movement. So this is what we're looking for. This is, and I've got here two. I'll show you the obvious one, and then I'll show you the slightly less obvious one. And the obvious one's the one that we have here chart-wise. What you've got here then is a steady sell-off move, which creates this fat bottom. As you can see, it is absolutely not a liquidation move, because the lack of large single print. Arguably, you could say this is kind of a machine gun move that fails to keep on going. And this creates then your fat bottom with your tail. There's your Christmas tree. If you imagine the mirror image of this being drawn, and of course I'm not a very good artist, that kind of makes a Christmas tree, you could argue. And that's where the phrase comes from on this idea. Now, what this suggests to you is that if we do start to reverse, this is going to be a steady drift up. People are stuck in this, and they're going to have to now start to exit, tick, 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 as the move goes back. And it's what you do start to see. You start to get this steady movement, and the point here being that you need to enter this trade early on. Once you start to get out of the initial balance, and in particular, once you start to escape value, that's the key bit with these types of trades. When you start to escape value, now you can look for the reverse. And so it's less about being able to pinpoint it from a profile and say that's where you want to be in. That would be a trade where, particularly you could play on, say, an initial balance break, for example. But what you're looking for then is, once you're starting to approach the top of value, once perhaps you're exiting the initial balance, this is where you can start to try and add onto the trade and play for that break. So you get a couple of little advantages here. You get a failed auction, which absolutely you could be looking for. Like a 45-degree line, for this to break down, you need a huge amount of energy, a huge amount of volume. So as soon as you see this drop, unless this is exceptionally strong, really, really strong, drive straight out of that initial balance, you can very quickly doubt this. So you're adding to the failed auction because of the context that you have. It's building the story up. So you see the potential failed auction, your context suggests that this may struggle. And as soon as you rotate back inside the initial balance, you've got a potential trade here. Once out of the initial balance, now is the time to make sure you can get into this trade. The expectation is this is going to grind up. Now, this is a scenario where actually you do get a rather accelerated move. This is a lucky scenario. And so when you get that, this is a chance to exit quickly. Take your profit, because this is not what you would expect. And this is a really important thing to remember. If you have an expectation and the market does not do it, then there's something about your trade or something about what's happening that you have not necessarily understood, or the market is transacting in a different way. So when you get this, you're expecting this to follow this type of pattern, which it has done, and grind onwards. That's going to take you back up. By this point, you're already trading here. You've now got the steady move back up the range. But when it pings it straight up, essentially does the job for you very, very fast. This is an indication you should be out of this trade quickly, because this isn't what you'd expect. And so therefore, this is something new, but it gets you to where you want. And so if it gets you to where you want, take the profit. The temptation here is so often when it rushes up to go, ooh, this might be a trend move now. This might turn into an explosive break of highs and we're going all the way up here. And the temptation, the psychology sort of gets you thinking, yes, we've got the big move. But what you have to do is, what the setup suggests or what the situation suggests is a grind. And so if you've got that in mind, if you get to your exit point very, very quickly, well, take it, because that's what you were looking for. And because it's not done it how you expect, you don't understand why, and so therefore you can't make assumptions or draw conclusions about what can happen next, because this is not what you expected to happen anyway. And that's why you should be out of the trade. Of course, there will be a situation where it does go up here and it does keep on going. But you're not going to understand why that's happened anyway, in which case you're better off to be out of a trade, because if you don't know why it's doing something, you're not going to know when to get out of it anyway. So I wanted to purposely give something that doesn't play out exactly as you would expect, because that suggests that all trades work out as they should. It's about having a plan as to what you're going to do if it does something unexpected. And for those looking, you've also got the 2-day aggregated Christmas tree here. You have this sell-off structure, which does have an element of, it's a very sort of tall, thin Christmas tree, but is more of a trend type day. You've got a couple of little trend elements to it, and it's also low volume in the middle. And then you get this basing formation. So if you move these 2 days together, you then have this much fatter base down here with the tail, which creates your Christmas tree over 2 days. Next day, you get the same thing, a temp lower, and then you get this drift back up range, a sort of steady crawl higher, followed by another crawl higher the following day. So you can see now why you're getting these moves. No trend element in this, much more of a sort of steady continuation and the following day, on the basis that you are steadily pushing out the shorts in this move. That's what's happening here. The only difference is they're quickly pushed out because of either a piece of news, some momentum, a correlated move up, whatever it was that creates that. You can also have an overnight positioning Christmas tree. Again, similar kind of concept where you get an overnight move like we talked about with the lower volume moves. This then is starting to piece together and bring in that opening play idea. You've got an overnight positioning move now. And so you've had the bid up, you've had this kind of gapping up market in the cash sessions. This is an oil profile. And what you then get is an overnight session sell off. And this creates your kind of Christmas tree. It has trend element to begin with, but the trend element can't continue. You create this very, very wide base with a little tail. So this is where the sellers run out. They've run out, yet they still try and play the next leg down by entering passively in this area, looking for the rollover. Now, when they don't get this, you can now look for the reversal. You're going to reverse this overnight trade. Also, the reversal of the overnight trade comes on the basis that you've got a gap in an upward trending market. So an upward trending market with a gap, many people are going to see as a chance to buy the dip, which is exactly what happens. You get the cash pit session open up here, test back, and so again, the overnight positioning Christmas tree, ideally, you want to play this as you escape where the majority of value is, which is here. So once you've gapped away from it, you have to ask yourself, do you really want to buy this? Because you're as close to the filling in of this as you are to the gap, or as you are to the value. So you have to judge this and say, well, I'm not aiming for much anyway. Therefore, there's little value in buying it here because we could reasonably trade back. So when you trade back, now this is where the interest comes in. If sellers are still strong, they're going to take hold here and continue the move down. But if they're not, this is where sellers trapped in here are going to start buying. They're going to start trying to exit as cheap as they can. And that creates support. This also is where you can then find people who are using this zone as a base for a reversal to start coming in. This is your classic block reversal. So you get the block reversal on the back of the Christmas tree. What does this indicate to you? Steady grind. And for this reason, you need to get your position on here. You need to take your risk on early. And the hard bit about a trade like this, or this type of trade, is that taking that position on early forces you to accept what feels like a lot of risk in terms of size without any real clarification that you're right. And that's what makes this a really hard trade to take. And equally, once the trade starts to work, it turns into a grinding move, which you have to sit through. There's not a great deal in this. If you look at the candlesticks there, the drifting down volume that says you're right, but nothing says you're wrong. And that's the hard part of a trade like this, of understanding the structure of the trade, which allows you to get in, and then trusting that structure as the market reverses. What's happening is these overnight positions are steadily being pushed out. Buyers are steadily gaining traction, which is allowing the market to then go back and fill the gap. And these types of structures aren't just confined to a day. You can have these types of structures on a weekly basis. This is a weekly Christmas tree. So a move generated by a reasonably fast early move in the week, or over a few days in fact, so it's not quite a week, but it's over a period of a number of days. So this runs from, if you could take it from all the way down here, Tuesday through to Friday, so the back end of a week. You get a drive up, and then you start to see here in the upper part of the Christmas tree, this is where volatility starts to drop. You see the volumes falling off in this zone, and this is what creates this type of Christmas tree structure again. You do get the washes back, which take away the kind of liquidation element of this day, and you get this fatter top. We need energy now to get the break, because buyers clearly haven't got enough left in the tank to keep this going. They've done all the work to get us from down here up here. They need more participation. They need more people to get involved here to generate that move up. And when the break comes, they need people to hold on to that break. Now, because this is a weekly situation, you're not really going to be looking at this thinking, we're going to sell this on the break. This is a situation that materializes over 5 to 6 hours. But what you're looking at is you're looking at this to form a bias, to form a directional skew. And so when you have this situation where you do fail to the upside, this little trade here, the open test up into range, provides you a much clearer opportunity and chance to then sell. That yes, of course, this is an opportunity to sell. It's a level, it's where the previous highs were formed, it's where we failed higher, but it's what's happened in the Christmas tree failure to the upside that tells you how the move's going to play. That's the important bit, because if you don't understand how a move's going to play out, as this starts to drift down, you're really going to struggle to hold the move, because this move takes all day and it's steady, 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 steady all the way down. That's what's going to make it hard. That's what's going to make the move really difficult. And this is what's so important about understanding this bit and this structure and the forcing out of the participants in here, which is what creates this steady move, because these people slowly get out because each of them is going to have a differing stop, and that's why you have this slower, steadier drop. Okay, final Christmas tree. This is looking at a combined full session and cash session trade. So this is a trade where what we've got on the screen is a full session hourly chart, a cash session 5-minute chart, and a full session profile. And it's the full session profile that gives you this sort of Christmas tree shape. It is a non-directional one, so loses an element of that sort of Christmas tree criteria in the directional movement, but it does nonetheless have the shape to it, which implies that there have been pockets of action on the way down. So what this profile in here shows is this move here, which has come from essentially a market that trades up and then trades back towards the downside. So you've got these little pockets of action, your failure towards the upside, another pocket of action here and there, and this is then running into the end of the day and into the next day. That's where you're getting this Christmas tree shape from. And so what this means is that in this move down, what has happened is you have people building positions. They're looking for the continuation lower, they're looking for this failed move up, down, break the recent lows, keep on going. So you get this Christmas tree type structure. You've also, if you're looking at the 45-degree angle from the low through the close to the VPOC, you've got around about a 45-degree line as well. Quite typical for a Christmas tree. So what this shows and what this helps you see is that if we do start to reverse, this again is going to be one of these situations that is going to put in a steady move. And when you look at the profile, the actual profile of the day, it does look like it has got quite significant single prints, a kind of liquidation move, which is exactly what it does have. But the nature of this move is not your typical explosive liquidation. Instead, it is a steady grinding move. There's no major sized candle in here. Yeah, they're all pretty even, they're all pretty steady on the way up, and then you get the just progressive grind on for the rest of the session. And so what's happened then, or what is happening here? This is the end of the cash session. Overnight session comes in and puts in this move. So this is your full session profile. And so what you're looking at then is to try and find yourself an entry point. This is the key bit to this trade. Looking for your entry, looking for the point where you say, right, I can play it from here. And the real obvious entry point is then escaping this base on the cash session. If you can get out of this zone, you can then play up, and that gives you this level here, 48.06, which also coincides with the single prints that come in on the full session as well. So that's going to be your point of execution. That's the point where you can say, right, this move is now on. And so again, this is one where you're waiting for this cash open. Cash opens just below the level. You know that you're going to get a bit of volume come the cash open, so you can use this to play through the level, play for the break. So as you approach cash open, you can ready yourself for this trade. The moment you ping through 48.06, this is where to take the risk. This is where you want to, as long as you've got this pace that comes in, that's where you're taking the risk on this trade. So that you're in for the steady grind move. And this is a reasonably quick move. Yeah, don't get me wrong, this is a 5-minute chart, and within around about half an hour, we have run up about 150 ticks. So it is taking everybody out on the way up. Nice steady move, which takes out the majority of this range. But it's and yeah, when you use the word steady, often that's assumed to mean slow. It doesn't have to mean slow, it's more about consistent. And what this shows, and what this enables you to see, is that you don't get the chance to buy a pullback, because every new candle just goes to the upside. It's a solid green candle all the way up, which makes this a very difficult move to add on to, and again proves why with these Christmas tree type profiles, the important aspect of a trade is to make sure that you are in early on, so that as it does the steady move up with limited pullback, as people steadily get out of positions as they're pushed against, you are able to maximize your trade there, because trying to add on after it's going is extremely difficult. We're going to move on now to a 2-day reversal. This is moving into the category of multi-day trades, so trades that are going to develop over a period of time. You need the information that comes from a couple of days action rather than just a single trade. You know, a lot of basic profile strategies relate to what happened yesterday. You know, a certain day type should lead to a certain play the following day, and that's what people generally look for. But if you don't get anything the following day, or you get a more consolidated period, this then is still adding to the story. And this is the way that I want you guys to start thinking, particularly when we move into the mapping part, of building up a story as to what is suggesting a market can keep going down, what is suggesting a market can go up. This way, you're building yourself a picture that is ongoing. And this is what a 2-day reversal trade is all about. It's about a market that moves in one direction, consolidates to send the move going once more. And within that, the move then starts to tire. People looking for the continuation, build position, a little bit like a Christmas tree happens intraday. But this is something that's going to build over a period of time. And it offers you very distinct entry points. So what you're looking for in a falling market example, you get a typical trend or less full-on trend. You know, a move that may be caused by a bit of news, a break of a range, and a kind of fast liquidation move. So a move that isn't fully accepted as a strong, sustainable move. If it's pure trend-like, then this does imply continuation. But you're looking for a move where the move itself still has doubt in it, in terms of whether it can really keep on going, because of the way that move has been structured. And on the back of that, you then get consolidation. You get acceptance at these lower prices. So there's kind of an acceptance that, yeah, the market has moved, so people will continue to trade down at those prices. But what then happens is you get this building of positions looking for continuation. And the issue that these people face is that without a continuation pattern, the market is going to struggle to keep on going. And so what happens is positioning gets tired. And within that, you will get tests back up the range. So where the drop has come from, people will test this back. The market will bid back up. And these create your execution points, because you're now seeing where the limit of buying can take you, and therefore where sellers are likely to place their stops. And so what we're looking for in a situation like this is a break away from this consolidation area. So it works a bit like a kind of 2 to 3 day consolidation followed by liquidation trade back up. You're expecting the break here to be fast, particularly if you've got an additional test, and I'll show you what I mean when I show an example. That where the balancing profiles are, where they tire the market out, people start to not lose interest, but they lose conviction. And that's the important bit. When people lose conviction, their tolerance to stay in a trade goes down. They're more inclined to get out if the situation starts to move against them. And therefore, a bit like a bad high or a bad low, The point where the consolidation breaks is what's then going to drive the acceleration in the other direction. That's the bit that you're interested in. And you're looking for this quick liquidation reverse. It's different to, say, Christmas tree, where it's a more steady, protracted reverse. It's a much quicker one. You're expecting the market to zip up. And it can be the case that this takes a couple of days to do. It may well sort of give you your first jump and then a second wave of that move. So like I say, it's a fast liquidation type move, different to a Christmas tree type reversal. And what makes these trades really valuable, in a sense, and what gives them this great opportunity, is that in this consolidation here, what you're getting is you're getting information about how far back the market can come before you find buyers again. And over these couple of days, if you think about the way people's mentality is going to work over these couple of days, people with positions, they're getting in on this move, maybe they're in down here, they're getting in on this move up here. Excuse me. So people are positioned long. They're looking for this continuation. And so to start with, the first place that people are interested in giving up on the trade is down here. They want to see it stay above this low, which incidentally, on this run up, comes in around about here. So that's your sort of 65.30s area. The next day, you then get further consolidation. The low moves up, 65.60. That comes up in here. And this is the period where we're not forming a continuation trade or continuation pattern. You form this kind of upward sloping wedge, but nothing, or upward sloping channel, but nothing more. It's hard to suggest that this is a flag because of the fact that the top of the pole is created nearly a whole day and a half from the initial move up. So we're running into a situation where there's no continuation pattern available, which erodes confidence. People who are long in here, okay, they've survived this first test back. They've now been shown where buyers are willing to come back in. And if they're looking for continuation, they now need to see the market show this. But the next day, you get a further consolidation. So we've now seen essentially 3 consolidations in a row on the back of a very quick move up. This is a tiring move. More and more people are getting long. More and more people are building position. More and more people are now stuck questioning whether this is really going to happen. And when doubts start to build in, this is where people then start to move their stops up. People become a little bit more cautious, and they then start looking at this low as a point where if we go back below there, now comes the time that people need to exit the trade. And so what this is forming, with the absence of the continuation, this forms an acceleration point, and you get 2. You get the acceleration point formed from these couple of days here, and then you also get the acceleration point formed from those single prints in the bottom of this area of value at around 28. So this then sets up a quick snap liquidation. The first people or the later people in, the first people out up here, give up, gives you the little snap down. And then once you get into this liquidation phase of the move up, which we know isn't going to hold a great deal of strength because of the fact that it is just shorts being forced out, you've now got the opportunity for a continuation move. And like I say, these can take a couple of days. The first move puts in a kind of caught in the hole scenario. And this is where, with your caught in the hole here, you're looking at that using the entirety of the information you've developed. And because you're in a situation where the market isn't in the right structure to continue and has started to put doubts in the minds of those who are long, the caught in the hole is actually not a trade that you really want to take based on the current structure. And once you break the low of the caught in the hole and the extra little area of support that builds in the overnight session, you then get the next leg down, the next flush, and that comes out of this little flag here, and you get a further consolidation and final flush down, giving you a very trend-like day down the following day. But all that comes from your understanding over these 2 days up here, the positions are getting tired. So the trade itself doesn't develop on the back of this. This cast out on the move because it's a liquidation move. This accepts value. Tiring, unable to move higher, no continuation pattern. The acceleration point then can allow for this quick whip back to the downside. We'll have another look. Again, what I would call it your acceleration point. And this is where you get an additional test. So in that consolidation phase, what gives you an even more clean acceleration point is when you get a test within the consolidation. So the consolidation occurs here. You have this charge move up. So again, break out of a range, market trades sideways, and then you get this rip towards the upside, a kind of double distribution. So participants are now going to be looking for the next day of a move. Any situation that arises at a period where you can doubt the validity of the move, this is always something to look for. In this instance, this move up happens on a bank holiday. So when you have a bank holiday, you know that you have a lower volume move. You know that with the lack of participation or lack of participants in the market, this is a market that can just get driven up on very, very little, and that's what creates this. So once that's happened, this is always a move that you can doubt. And so these types of trades always come on the back of a move that doesn't necessarily have all the hallmarks of a strong move. It doesn't have a trend element to it. It could be formed on low volume. It could be formed on a liquidation. Any of these bits of information. It could be formed on a correlation move up. So where you might have, for example, commodities go higher because the dollar weakens. Ultimately, commodities have not got there on their own back. And so these are situations that you can look for. So aside from the fundamental, we've got a situation where this is a doubtful move, and then we put in some consolidation. But within this consolidation, you then get this one test down. You get this tail. And this is what I call the buyers getting away with it. Buyers who are determined to stay in this move will get this test down, and this now gives them information. This shows them that that is as low down as they need to go. And so everybody brings their stops to here because they've had the test now. They found out that sellers have got no more down here and that buyers are able to push the market back up. So this becomes your acceleration point. That comes in at 12.495. So now you've got a reference to try and take this trade on with. You know exactly where you're interested, and it's on the break of this low. And when you get that, this is where it comes in. You've had a market that starts off, small gap down, open drive, breaks the bottom of the IB, small flag, acceleration. The flag plays you into the acceleration point. And that acceleration point is what then triggers the stops. Because everybody over these days looking to place a stop, if they've got away with it or they bought on that little dip, everyone's now looking at that low as the point where this move dies. And as soon as it goes through there, the stops go off and the fast move comes, which is what gives you this rip down, flag, and again. And this flushes everybody out, takes you back towards the previous range, back into value on that previous range. And then we move to a situation where it's a case of, can you find buyers back down here? Or is this going to be a market that keeps going? In this instance, we do find buyers. The market does stabilize, and we then get the full reverse back. But the secondary move, whether you get the full reverse back, is more about where you fall to and the structure that develops from there, as opposed to it will always reverse back. Some will continue onwards, and that's something that you're going to develop your plan as the day progresses. This is a very, very fast liquidation move early on. If you can't then form your sort of B-shape balance down here on the day, that's where the reversal is going to come from and send the market back up to where it came from. So far, we've looked at a move that then is turned around with a quick sort of liquidation, which is your classic two-day reverse situation. Doubtful move, 2 days of consolidation, building positions, looking for the next leg, doesn't happen, rip to the upside or rip to the downside. Here what we're looking for is to play the trade, but recognize that it doesn't have to turn into a liquidation like that. And as long as it is not reversing back, the trade is still on. But it does make this a much harder thing to take on. So I want to go and have a look at how could you go about taking this trade on when it doesn't do the break acceleration, or when it breaks and goes without you. So similar principle. You've got the fast sell-off, which puts in this essentially Christmas tree type profile. That's this move down here. So straight away, you're already moving towards the idea of this could well be a steady reverse. But you still get the 2 day structure of 2 days of balance down here. Importantly, with closes high as well. So when you're stacking up the information here, you're going through this thinking, right, we've had a sell-off, you've got a Christmas tree type profile. And on the back of that, you then get a further consolidation, more shorts building in this area down here. And then we get a break of the low, a high volume break of low and straight back into range. That gives you a really obvious tail. This immediately turns your doubts up on this move. You already have doubts because of this structure. This then really turns your doubts up because there's no continuation pattern here anymore. You were struggling for a continuation pattern to start with in here, but now very much there isn't one. You then get another day of consolidation. So this is a move that has not attracted buyers yet, but equally has shown sellers that they can't keep on going down. So this is the tiring part, the part where volumes do start to drift off, and that's what you're seeing in here. Anybody who is selling gets this little drift out of the range, or out of the range formed over the previous couple of days, basically inside value at the bottom of this Christmas tree day, and they get the test out. Sellers who stay in, and bear in mind, the sellers who are going to stay in are the people who have got short from up here, who are waiting to see the continuation. They're not forced out. They could, even if they put their stops above here, still take 50% of this move. So they're not giving this up. This is your kind of more medium time frame participant. But once you get out of the range and back in, this now forms a clear point of where to give this up. And this is that sellers getting away with it move. Market comes out, they don't get forced out of their trades, market rolls back, and we then get the drop. We then get the sellers coming in looking for the drop, looking for the next leg down. So you now can see exactly where the reversal is going to come from. And when you look at it on a profile, you see, well, open down here, close up here, wonderful, nice, easy trade. Buy it, up it goes. This is a full session profile. But the reality is not quite the same as that. And so you have to look at the reality of what's happening when the trade comes to be taken, and how are you going to use that in order to take the trade on. And this is what happens. These are the two consolidation days. This is the test lower. This is the sellers getting away with it. So this is the point, the little orange line, that's where the break comes. That's the bit that you're interested in. Now what happens is the break is steady and in the middle of the overnight session. This takes the opportunity away, but it doesn't give you the liquidation. And so as we've talked about with a delayed caught in the hole move in the past, where the structure is still there, but the play is not as it should be, you can then look at this as a way of, and look at it as, I need to find an alternate way of taking this trade on. In this case, you've got two options. After this move up, you've got either the break of the current high, or you've got a pullback to the point where the acceleration should have happened. This is where buyers gain control. Up to there, it's been reasonably even between the two. Buyers did manage to exert some control down here. When the move couldn't keep on going, they were able to come in. But apart from that, they've not shown any great control. They couldn't maintain control here. And so this becomes the point where if buyers are going to take control, it's going to come here, and that's going to set the reverse off. So you can look at this now as a point where back here gives you an opportunity, or break of the high, and that then gives you your acceleration and your straighter move. Again, it is the reversal of that Christmas tree, or that Christmas tree on the first drop down. And that's where, again, that steady move's going to come from. So what's essentially happened is the point where the acceleration should come, nobody does accelerate the move. Nobody gets forced out. And so because they've got time to get out, we don't have the situation of the charge up. And therefore, any pullback is then a second opportunity to find out if buyers do have the strength and then play the move towards the upside. So it's about sort of looking at what should happen, looking at what is happening, and asking yourself, well, how can I now adapt to this trade? What is now potentially available? And as long as you're above there, it's still on, and a break there, you've got a new acceleration to play for. So let's go and have a look at I call it a 2-day reverse because you get 1 day, 2-day reverse. But really this is a kind of 1-day reverse trade and more of a play on a drop, neutral, extreme day and then reverse back. But I want to have a look at this from the point of view of how you judge the trade. And we'll look more and more at this when we go on to game playing and risk management. But trying to take on the information that you've got over these couple of days, building this together and saying to yourself, okay, well, based on what I've seen, I can now start giving myself probabilities. The probabilities are not based on empirical research and you working things out. They're more, for want of a better word, a numerical indication of conviction. What do you think the chance of this happening is? You know, everybody has situations like this where you say you're watching some sport and you say, I'm 90% sure that that team's going to win. you don't have any empirical evidence, but you've seen situations like this and you can be confident. And so the 90% is really an indication of conviction, not of any kind of statistical merit. But what you're trying to do, and this is this discretionary element of trading, you're trying to say to yourself, okay, what do I think the probabilities of reaching different points are? So based on the structure, we've had a sell-off, which has created a fat bottom. You've had a neutral extreme day with a tail, so failure to keep the move going. And from a candlestick perspective, open close in the same place. So this creates this sort of gravestone doji. So what we're now looking for is a reversal. You can plan this reversal out, that if you can get out of this little fat bottom area above the high of the day, the move can go towards the upside. So that's 77.02. The market has clearly shown some willingness to go up in that we've opened above value, tested back, traded higher. So you can now be sitting in this range here with a view as to the probabilities of reaching different points. And like I say, this is a conviction indication because you're not trying to add the probabilities up that if it doesn't do this, it must do this. So what I'm suggesting here is you've got a 60% chance of reaching 17s. Break here, and that's going to run you up into this area of low volume up here. So you've got a 60% chance whilst we're trading in here. I would equally view this as only a 15% chance of getting back down towards 50, back down towards this VPOC, because of the way we've currently traded and because of the structure that's preceded. And you can then also increase these probabilities when certain conditions are met. If you break 02, the probability of going to 17 is now more like 80%. And in fact, you can then start considering a higher move because this not only puts in the reversal, but then sets you on the way to reverse this fat bottom profile. So you can now got an idea that now if you pass 02, you're looking at 80% probability of getting all the way up here. If you pass 70, so get yourself back inside value, now you've got a 60% chance of going down towards VPOC and then potentially the lows. So you're assigning probabilities and then also conditions on them. This way it makes it so much easier to take trades on when you reach certain points. All of a sudden, with the push above 02, you're now already decided that there's an 80% chance of getting to 17 and even all the way up through the range. Which says to you, you need to take risk on here. Because you've already said you're extremely confident this is going to happen. And this is then a way of being able to manage your conviction into a trade. Because of the level of confidence, you want to be increasing size to play this move from this point. That's the way you want to be trying to approach this trade. And that's where using the structure over a couple of days and then forming ideas about the likelihood of certain things happening allows you to then increase size and increase risk at certain specific points. And this is what ends up being the entire day. You get the drop, the consolidation, final leg of the drop, which creates this fat bottom profile, the daily hammer, back up into range, and then you get the sweep through this weekly fat bottom as well. And so again, you then see, looking at the even wider structure, how 17s to 52 becomes an area to sweep through entirely. And this is why those probabilities are there. Why you can say once you got above 02, it's not just the chance of getting to 17. Once you pass 17, the chance of sweeping up here is then extremely high as well. And that's then allowing you to see a much bigger trade because you're not just purely looking at what happened yesterday, trying to take a trade based on a neutral extreme day where you say, okay, it should go up. Yes, it should, but where? How? How do you expect this to go? How fast do you expect it to go? Where do you expect it to accelerate? Where do you expect it to slow down? This is why you go into the detail of having this kind of construct of a 2-day reverse with a fat bottom. You now have an idea of what should happen, how it should happen, and this kind of steady, relentless bid up because of this fat bottom profile into a sweep as well. So it gives you this clean move towards the upside. Final thing we're going to look at here then, on a tiring structure, is looking at a one time frame reversal. Now, we talked briefly about one time framing in the past. One time framing is a situation where you don't break the low of the previous candle on an up move, you don't break the high of the previous candle on a down move, a daily candle that is. So what this is showing then is a market that is forced in one direction and also tiring. And this is where as I talked about with, say, a normal variation day, the implication of a day type varies with what has preceded it and where you are within a move. So what's happening here then is you will have a situation where you get a breakout. But once you have the breakout, you don't get a consolidation and a next leg. Instead, you just get this steady continuation, smaller contracting ranges, contracting volume that doesn't test back. And what this does, it forces positioning. Because buyers aren't able to buy on a pullback if you're on a move up. Instead, what happens is they have to just move their bids up. And it's the FOMO trade. You fear missing out on the big move, so people constantly add or move their bids up day after day. And the longer this goes on, the more notable it becomes, and the more people feel that they can't participate, or, well, not that they can't participate, that they really should have participated, and so therefore then start to chase the move. What you're looking for then is a change in this action. You need to see initiative in the counter direction. This then puts everybody on alert for their positions, because as a market grinds higher, so it doesn't put in these phases of initiative, positions steadily skew upwards. So people's average position increases. And the more people feel that they're not going to get the chance, the more people start to add on later in the move. And so you run out of people pushing and you run more into people just buying any kind of pullback. So this is kind of a long-term wedge, if you will. But illustrated very much by the shapes of the profiles and the lack of participation in these types of movements. So what we're looking for then is when you have these steady continuations, the important clues then are the break of the one time framing, so the ending of the one time framing, but also any clue where that one time framing pattern changes. Because that could be a pre-clue. Any increase in volume compared to the move that had been going as well is also a clue. So you're looking at these little clues, and this should then be an indication to trigger the idea that now you can look for the liquidation down, the sequential taking out of lows. And what this does is it creates a move that should accelerate as it drops. So the move will get faster and faster and faster as it goes. It may start off steady, but it's then going to accelerate. Unlike, say, a Christmas tree that creeps, this is a move that initially might give you a quick liquidation and stall, and then as the move keeps going, is then going to accelerate. So that's what you're after here. You're after a move that's going to gather pace. You can almost sort of get in, take the first bit, and then go and play for the much larger reversal trade. So we're going to look at a one time framing failure. There is a sequence of one time framing followed by one time framing and then the reverse. So start this off with looking at this from a candlestick perspective. And this is in a move over nearly an entire month. But what we have, here's your one time framing move. You get a breakout. So there's your breakout move. You get morning consolidation, drive higher, trend-like structure. This is fine. This is all good. What you'd be looking for then on the back of this is a consolidation day and then the next leg of move. But you don't get that. You get the next day, move slightly higher. It is a consolidation, so okay, that's fine. You're now looking for the drive on, the next initiative, new buyers to come in, accept these prices and go, okay, let's keep going. But you don't get that. You get another small range. You get volume falling, and we get this progressive move higher. Small ranges, very consolidated acceptance of value, little ranges higher again. One move that shows some degree of initiative, and then another consolidation. And the first time then in this move where you have 1, 2, 3, 4, 5, 6 days of one time framing, higher lows all the way up, you don't get a higher high. This is a clue. It doesn't mean the move's going to turn, but it's a little clue. So then the orange is the break of the one time framing. And this is the first break just here. And initially, as I said, if this is a one time framing break, it doesn't necessarily have to be fast straight off. So you're waiting for it to begin and then accelerate. So the market begins, the little drop, breaks the low, doesn't really accelerate, comes back into range and stalls. Okay, that's fine. The next day is really key then. This is where, having broken the one time framing, you want to see the liquidation. These people get forced out and it doesn't come. You get a break of low, nothing comes of it. A late break of low reaches the first low of the one time framing. Ideally, it should take the whole lot out, and often in one. So in this move that accelerates, it can take the entire one time framing move out. And on the back of this, you then get a gap up and it starts again. So essentially, buyers have not got put under any pressure here. You got maybe some of the people who bought on this day might have got forced out, and that's it. And then you get an even steadier small range move up, more very, very low volume. But right towards the end of this, you start to see a little pickup in volume. You look at the average volume, particularly on this day here, you start to see a little pickup. So this is a little alert that something might be changing. You then get an even smaller consolidation day, which is showing you that buyers aren't even willing to push towards the highs. They're happy to just sit any passive drop. They're going to let the smallest drop become a chance to buy. So they come in and buy that. The difference in the two breaks here, and this isn't a prerequisite, but it's a clue. You get a break of high. Now, you can't call this a false break until you break the low, because this could well be like any of these other breaks of high, and the market just sticks above it. But when you come back down and break the low of the day and then the low of the previous, the one time frame is ended with a failure to keep going. This now is suggesting that we can move down. So the next day, what you're looking for is a break of this low and the acceleration. You're looking for the move to take out all of these lows, and on each low, you're looking for a further acceleration. So you've got a really clear target for this trade. You've got a clear expectation of a move increasing in pace as it goes, as it stops people out all the way down. And you're expecting this to come in with much more volume because people are being forced out. It's much more of an active move. And what you then get on the back of this is a continuation and a takeout of all of the one time framing over the next 3 days. So what's taken the best part of 3 weeks to do is unwound in 4 days, because of the fact that you've got the positions constantly trapped all the way up. They tire as they start to exit, the move then will roll over on them. So this is what it looks like, the one that doesn't work, so that you can see the difference in the two. This is your one time framing move, and this is what I mean about profiles that don't give you a great deal of confidence. Go back to the question of how good a job's the market doing? Not a great job. The only sort of initiative looking move creates a caught in the hole, to which the market then just stabilizes. It doesn't reverse, it doesn't go up. This again forces more people to move their bids up. You do again get one more push up, and on the back of that, incomplete move, consolidation. So here, the break of the one time frame, you're looking for the move down, and instead it's just a two-directional trade once more. On the next break, this is the point where you really need to see the market drop. Same thing, small break, two-directional trade. This is the problem that you may face on a one time framing break. This is the bit where you have to go, okay, I needed to see it accelerate, I needed to see it drive lower and keep going. It's not done it. You were expecting this move to break here and go down here, and it's not done it. Therefore, you have to step away and say, okay, this is not the one. And this is what you get from a candlestick perspective. One time framing breaks, here's the chance to move down, not taken, open test drive, back up, okay. So we've changed the direction, but we've not really progressed the move. And even with the late drop, nothing more comes of it. The next day, we put in a wide initial balance, which immediately suggests a bit of a problem for this move going lower. And even on the break of the initial balance down, on the back of a failed auction, it's low volume. This again is not an indication of people being forced out of position. And so whilst yes, it does go once again late on in the day, this is all done on low volume again. This is where the doubts come in. As soon as you get the gap back up, the one time framing or the one time framing break has failed to then create the movement to the downside. Whereas when you get the one that works, completely different. Here's your even more doubtful one time framing move, in the sense that these ranges are getting progressively smaller, value areas are getting tighter. And so whilst every day opens and closes near the top, it's just people forcing the move up as opposed to really driving this. It doesn't drive, create a single print and a new area of trade. It's just a drift. Then you get a small change that we don't get the close quite so close to the high on these 2 days. And there's your false break. At least you know it's a false break when we close lower. Value gets driven to the low as well. This is your break of one time framing. This is the beginning of that accelerated move. This is the first drop that's now you're looking for acceleration. This day is the one that matters. So now on this day, what you're looking for is acceleration. You see it there from a profile really easy. No volume, single print, that's what you're after. The high volume node, the VPOC, gives you the chance for the snap down as well, which then facilitates the break of all of the one time framing in one day, in one move. That's what we're after. And then the next day, the incomplete move, close at the low with a very, very bad low, opens up the next leg of this move down. So this is more what you're looking for, and it's all about the taking out of these lows. It's a sequential take of lows, just bang, 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 bang through all of the lows. So you take this onto a candlestick, this is what you get. There's your false break and the grind down. You get, again, a fat bottom profile, which is what causes the overnight gap up, but this does not then keep going to the upside. You get a tight initial balance, so straight away you're stacking the info, you get tight initial balance, perfect. This is good for a break, not like the last one with a wide initial balance. Once you get below the initial balance and back into this little range, which is the low of yesterday, the low of the first stab through the initial balance, then the initiative comes in. This is the point where you're thinking, right, now we can go and take out all those lows. And it does. Straight lines down. Pullback gives another chance to then go for the final leg of that move. That's what you're looking for on a one time framing break. You're looking for volume to increase, and then you're looking for it to increase further as you take all of those lows out in one. So that's what you're trying to do with structuring a trade over multiple days. You're understanding the tiring nature of a move and seeing how this can turn, because if a move is tiring and people are positioning themselves, as soon as they face trouble, they're going to get forced out of these trades, and that's what's going to create this fast reversal back down. We're going to move on to mapping out situations. So rather than looking at specific patterns that map out, we're going to look at bringing the information of multiple days together so that you can then build this idea of how the market can trade over the coming days. Pick out different trades that are going to be available to you after certain sort of foreseeable patterns emerging. We'll wrap it up there, we'll move on to mapping.